Have you noticed, can the brokerage or Wealthsimple in this case, can they change its house margin requirements at any time, or do they give you notification?
They could. International broker does this during any market correction. Whereas with Wealthsimple, they could change it. They will change it most likely. And I've seen this during the whole April Liberation Day, when that whole massive drop, a massive up spike went. So during that massive drop period, broader index-like funds, both in the US and the Canadian market. So you have the typical, USCL, QQCL, HDIV, H yield. You have QDTE, RDTE, QQQY, Defiance, all of those more broad exposures. They kept it at that 30% margin requirement. But then when it comes to more riskier positions that are specifically focused on, single stocks or single sectors, then they will up that margin requirement to at least 50%. Good evening, YouTube. So this is a collaboration between myself, Convos with JJ, and we also have our guests and collaborators, Paul Santori and Shawn Clark, both from Better Call Paul. So tonight's a very special episode. Basically, we will talk about everything finance related. We'll talk a little bit on margin, a lot about investing, tackling beginner questions, really anything that sparks a good conversation. If viewers are familiar, I did a collaboration test not too long ago with the great Leon Lee. And so this time around, we have even more special guests, both Paul and Shawn. So let's start with Paul. Why don't you introduce yourselves to both your subscribers and my subscribers and any new viewers that are coming on to both of our channels?
Sure. Thanks, JJ. My name is Paul Santori, and together with Shawn, we run the channel Better Call Paul. And we were both on Blossom. I guess I was probably a little bit more than Shawn was. And I was lucky enough to be interviewed by Mo from Momentum Finance. And then I was interviewed by Ari. And after those two interviews kind of went well and my Blossom followers started to skyrocket, Shawn's wife and my wife got together and told us that we have to start a YouTube channel.
That's the only natural transition, right?
Right? So we
They run the house.
I tried to tell her it's not as easy as you think, and we hemmed and hawed for a few weeks, but eventually we decided back, July 18th to go for it. Yeah, I guess a couple of days before that, I started getting the channel ready. And then July 18th, we did our first video, which was literally just sitting down at my kitchen table and introducing the channel. Yeah, so it's been great. I've been on Blossom, since I think November 2023. I've been a DIY investor since 2020. Like you mentioned, when you and Leon were talking, everybody during COVID decided to invest. Now, I was still going to work, so it wasn't like I was at home bored. But it just felt like the market tanked so bad. Now was the time to get in. It's like, now's the time that I can afford to buy these stocks that used to be so expensive, and all of a sudden they were all on sale. So I just decided, you know what, I'm gonna technically fire my financial advisor, move everything from Investors Group, and open up a brokerage account with RBC because that was my bank at the time.
Right.
And that's when I did it in 2020. I've been doing it since. Of course, as you can tell by my T-shirt, I started following Adrian, Passive Income Investing, right? But I think he had a whopping like 300-400 subscribers at the time.
Probably.
But anyways, followed his journey, and it's become my journey. And now, now we're having sort of the same success that he's had. We're just a few years behind him, and it's been great.
Awesome. What a great introduction. And what about you, Shawn? A little about yourself?
Sure. Hey, I've been investing since about 2020, but it was more done through my bank. I didn't know better. I was doing it through Scotiabank, paying, $9.99 a trade, until Paul I really started having bigger conversations with Paul, and he started educating me a little more about, doing it yourself investing. So I'd say just after COVID, I opened up a account with Wealthsimple myself and transferred everything I had into Wealthsimple. And I was sort of still meandering around with purchasing stocks. I'd purchase Air Canada. I wasn't
GME.
It is kind of funny story, but
Yeah.
and,
Do you still have GME
it seems
to
like
this day?
I still own some. I
Oh
still own
my.
some GME. Yeah, still holding on. I've got about $10,000 tied up in it, American.
Wow.
Long story short, Paul's talking me out of selling it right now, waiting till about $25. So,
Mm-hmm.
Yeah. And
but anyways,
usually, if you ever follow GME, JJ, a lot of times it will spike for a day or two
Yeah.
and hit like $30.
Something
So I'm
like
like,
that, yeah.
I'm like, you've had it for so long, you might as well wait for a good day and then sell it.
That's true.
I
How much
think
did you get it? How much
well,
originally?
if you want to go over that real quick, back in the day before it had its climb up to the 400s, I
Yeah.
was buying in at $70 to $90 a share. I ended up buying 72 shares of it, all of them at under $100, and I sold them all right around the $250 mark.
That's
It,
exciting. That's great.
yeah, it hit its
Yeah.
peak. I caught it on the way back down. It's what really started my portfolio after that. It wasn't huge money, but it was good money. And then I wasted my time with little things like BlackBerry and Air Canada and so on.
Mm-hmm.
And then, Paul put me on the right path, saying, Shawn, you need to start getting some income flowing. You're getting older. You're going to retire one day. I don't have a pension.
Yeah.
Oh,
So,
yeah, for sure.
yeah, the big keyword there, pension, right? And that's when I really started focusing. Really, my focus has only been about 2 years now of actual income invested and getting uncovered called ETFs, is even shorter period of time. But I'm enjoying it. I think I've learned a lot and I've come a long way. And I think I'm getting some really good returns on my money right now.
Very nice. Very nice. If you don't mind, Shawn, if you want to just put the microphone a little bit closer to your mouth.
Yeah.
So,
Sorry about that.
yeah, there you go. Much
Is it
clearer.
any better?
There we go. Yes. If you want to just repeat that last sentence that you just mentioned.
That I've come a long way in the last
Exactly. Mm-hmm.
yeah, I really have come a long way in the last couple of years, and I've learned a lot, not just from Paul, but also watching a lot of videos, and
Mm-hmm.
obviously like Adrian and Mo, and watching videos and learning, and finding out what the correct path for my type of investing is. And I really enjoy it. I'm really having a good time with it. I look forward every month to for my dividends to come in, and adding money to my account and purchasing lots.
Awesome. That's great to hear. And basically, I'll do a little introduction for myself as well for Better Call Paul's viewers and subscribers. So I'm JJ. My real name is Jackson, and I am a pretty active Blossom user on the Blossom social investing app with a handle at JJ Pandy. So JJPANDIE. I am 23 years old. I have been investing pretty much about 5 years now, give or take. And so I really started back during the early COVID era, which I would say would be the majority of people, because everybody is very familiar with the restrictions, with basically curfews. There was not really much to do really back then. You were really limited with even being able to go outside at one point. So it was very boring. So there was a lot of free time to really, explore different avenues. There was investing, there was trading, and then there was pretty much Amazon, so buying stuff online. Whereas and then there was also, I don't know if you guys remember, but there's also a huge era of basically a Bitcoin mining and then GPU scalping. Whereas during that height of the Bitcoin mining phase, a lot of people that I know, they weren't really focused on the mining aspect. I do know one or two friends who were really into Bitcoin mining, so buying a huge amount of graphics cards and specifically for that.
Mm-hmm.
But I also know a couple of friends who were more strategic in the sense that they knew, because of that, they didn't really get into the hype of buying into those graphics cards. Rather than they actually uploaded a huge amount of graphics cards from the start and then scalped the value of those graphics cards when selling to these miners. So
wow.
From that, I was very intrigued on. Basically, I knew from at the very beginning that NVIDIA, which pretty much dominated the entire graphics card units back in 2020, even though we did have AMD, we had a little bit of competition between AMD and Intel, whereas AMD kind of had their start of the Ryzen GPUs, which was pretty much their new flagship division that was pretty much rebranded and was able to trade blows neck and neck with NVIDIA, who was the king in the AI architecture and basically in the semiconductor space. So from that, I knew that Bitcoin mining was hot and that graphics cards from NVIDIA was also very high. So at that point, I had basically a small amount of money set aside both on NVIDIA and the Purpose Bitcoin, spot Bitcoin ETF, BTCC. And so those two positions were kind of pretty much in line with the rest of my positions that I had purchased, including Coca-Cola, which I really liked back then at the very beginning for that dividend growth position, because who doesn't love dividends, right? Like when you have, there's usually three different sets of investors, I guess, investing mindsets. You have the growth, you have the dividend growth, which is you have basically dividends that you receive either every quarter, every half a year, or every once a year that usually goes up every year. That can pretty much compound and have trade blows with technically the growth investors. And then you also have the income space, which is pretty much what we'll be focusing on. But back then it was kind of it was a dabble in between the growth and dividend growth spectrum. And then I also had a huge amount, I would say roughly about over 90% in the Canadian Couch portfolio, if viewers are familiar with, which is buying the all-in-one equity portfolio, the EQT. So there's one from iShares, the XEQT portfolio, the one from Vanguard, the VEQT portfolio, and then we have the one from BMO, the ZEQT portfolio. And I believe Horizons, which is now known as Global X, also had their HEQT portfolio, which got released in about 2022. And then Fidelity also came along later on in the FEQT with their own FEQT, which has a little bit of a spin in their allocation, which also contains about 3% in Bitcoin allocation, give or take. And so you can see now, about 1 to 2 years now, what the price performance between Fidelity's EQT and the rest of them, because of how well Bitcoin has been doing, their technically all-time returns is pretty much better than the rest of them because of that 3% allocation in Bitcoin per se. So yeah, so that's a little bit about my past history.
JJ, at what price were you buying NVIDIA at?
Oh man, so I didn't buy that was so while ago. I don't remember, but I didn't buy the US stock. I had the CDR version. And so so because NVIDIA's price was so expensive, I only had one US dollar position in Coca-Cola, which I kind of didn't like. I actually sold out of Coca-Cola 6 months afterwards because that was just one position in USD. And I didn't really want to deal with the currency exchanges because because of how much I started with, which was not that much, playing with Norbert's Gambit didn't really make much of a sense. Because when you have Norbert's Gambit, it only makes sense when you have, let's say, $10,000 or more that you'll be exchanging, because you also had to wait those 3 days with Questrade that you would be allowed to journal those shares over. So there's a 3-day settlement, and then you can share it, and then you can sell it in the DLR.U price version, and then actually have access to the USD. But I only started with about a couple $1,000s, so it was not really worth it. And plus, I only had like maybe a 3% allocation Coca-Cola, so it was really a small amount. So I didn't really like looking at that US dollar position, so I pretty much got rid of it and then sold it back into Canadian and then stuck with Canadian holdings for the rest of it. So I had both basically the NVIDIA CDR, which was trading in, oh man, I don't even remember, maybe in the $10, give or take.
How high did it go? From $10 to
pretty high. I think it went about 150%.
Wow.
Higher.
Wow.
Yeah.
Like I know you have quite a large portfolio. I'm just trying to wrap my head around it, right? Because you were 18 years old, started with a few $1,000s.
Yeah.
Now I know NVIDIA and Bitcoin are two of the ones that you did well on, but I'm still trying to figure out like how well did you do on those ones? Like from $1,000 to hundreds of thousands of dollars, or
no. Not really. That was really a small portion of, I guess, the consistency. But then the rest of it was I also had a bunch of side hustles and businesses that I was working on, which also generated income that I was able to.
So how much were you investing on a monthly basis?
Okay, so going into very technicals, I would say at the beginning, not that much, but in the last 3 years, I don't want to scare viewers, but anywhere between $5,000 to maybe $10,000 a month.
Wow.
Yeah.
That's amazing.
But JJ, I won't ask dollar figures or anything, but approximately how many different positions do you hold in your portfolio?
As of this current moment,
Yeah.
I would say, if I remember correctly, with my Blossom portfolio, we have about 29 different holdings. I would say 28. Technically, 28 of those holdings are more income focused, but then the vast majority of them is focused more on the growth preservation. So like mini yielders, not really like high yield. So you have the, between the 10 to 15% range, which is pretty much in line, that you would have a growing, at least a steady or growing NAV, because share price appreciation, especially at such a young age, is very important, because you don't want to rely too much on just the yield portion, whereas you'll be sacrificing a NAV, which also means that you will be paying more in taxes now. Whereas you can kind of, you can either keep some of the proceeds or reinvest not as much to keep that NAV afloat and basically grow your overall portfolio as well. So I think it's very important, especially for younger and beginner investors that are getting into the cover call space, is not to focus too much on the yield, but also understand exactly what you are buying, at an average yield percentage that's tolerable, that you will not make any sort of rash and emotional decisions as soon as any market correction occurs. Because when you look at ultra yielders, even though they have very high yields, you will have inconsistent or going down or like slightly decreasing NAVs. And so that's usually the case in a flat or bull market. But as soon as a market corrects, that decline in the NAV can get magnified, which can cause these beginners to make more irrational decisions. They will start panicking and to actually lock into those losses. So I think that's a very important thing that most people need to recognize as well.
Paul and I have had some conversations about how many positions to hold in our portfolios. My comfort zone is right around 25, 25 to 28 max. But Paul's more comfortable with almost double what I have.
How many do you have right now, Paul? 40 holdings?
I think about 40. Yeah. Yeah, I think maybe about 40. I do have a couple of holdings that I'm just, like, I have Hive, Hive. Are they a Bitcoin miner or?
Okay. Yeah.
Right. But I bought them, let's say, when they were at about $15 a share, and it dropped down to like $3. Yeah. Okay. So recently they've shot up like 100%. But even at 100% up to $6, well, my cost is 15. I'm still way down. So some of those positions I'm just waiting to maybe break even and then get rid of.
Right.
But actual covered call income, about 40, which I am kind of trying to maybe streamline a little bit. With all these weekly payers now, I don't know about you, but I keep track of all the dividends. It's too much. With now that they all pay weekly, like the YieldMax ones pay weekly, right? It's a lot, every week keeping track of all the dividends. So I'm trying to streamline it a bit.
For sure. I understand that feeling, because previously I had I still have approximately 8 positions in YieldMax. So I have the ULTY, which everybody knows what that is. We have NVDY, the one on NVIDIA. I still have the original positions in Tesla, TSLY, that I've just been sitting there for like 2 years. I'm finally positive on it since about a month ago. Wow. Oh my God, that was because you know how when Tesla, because with the aggressiveness of YieldMax, as soon as the underlying holding, which we all know, Tesla, starts dropping, well, the cover call version is going to drop as well. But because they're so aggressive with their strategy, and before they changed it to like have a bit more capturing of upside, when they finally added like cover call spreads, which actually allows some appreciation. But because of how volatile Tesla is with their up and downs, it's very hard to capture the ups when we're capturing the downs. So Tesla it can never basically track Tesla properly, just because of their underlying strategy without any sort of leverage. So I still have that position that I'm finally going to sell. Finally.
Do you have Coney?
I do have Coney, yes. I
think Coney's actually doing worse than Tesla now.
Yeah, probably.
It's like $6 a share.
Yeah. I'm actually surprised they haven't reverse split yet. Because especially since Tesla got reverse split like twice, but it was around
when
the $8
they reverse
range.
split Tesla, people got upset, right?
True.
So now
But I
they don't
mean,
want to do it.
they have to realize that reverse splitting actually doesn't change the value of their position.
That's right.
Like what Adriano said, like technically reverse split, you're just basically, you're getting the same dollar value, which is at the higher price. You're just getting, you're trading in half of your shares for a higher price. Yeah. And technically speaking, it's actually better because with fund managers, they are actually able to manage their inherent leverage and their collaterals better at a higher price. Whereas at a very low price, sorts of like, there's, I think, legal issues and sort of like trading options in terms of like having a NAV price that's like within like lower than the $5 range. I think there's impacts even further on the performance. So that's actually a good thing if the reverse split, which means that technically speaking, if the underlying holding is still around and there's still an options market, then the cover call ETF on that holding will never go to zero. You will still technically get paid for it, but you just get paid less.
Yeah.
Right?
Yeah, I'm trying to get rid of my YieldMax single stock ETFs like Coney and NVIDIA and those before the next big correction or big crash.
You think it's coming soon?
I don't know if it's coming soon. It might be a year from now. It could be 2 years from now. Who knows when, right? But I think those specific ETFs are going to get crushed.
Oh, hands down.
And then are they going to recover? Probably not.
Because they're not even looking at now, since we've had that such a strong bull run in the past 6 months, their price performance is still crap. Yeah. Like they're not really going up, they're still going down technically. And we're technically in a strong bull run.
Pretty good, right? That's the thing. Their yields are still pretty good. So to try to sell them and replace them with something that's going to pay you the same is hard to do. But if they, if Tesla goes from $8 down to $3, you're going to lose everything you've made in distributions. You're going to end up losing. So
exactly,
that's my goal, is to try to strategically get rid of them one by one. Like you said, when you're positive, or, I'm looking
for pretty close to positive. Yeah.
Yeah. I'm looking for kind of opportunistic moments to do it.
What do you think you will switch your holdings to? The ones from Coney, from Tesla, and all of those?
Well, last week I sold...
Similar strategies to Roundhills, or would you actually like streamline into one of the all-in-one baskets?
So what I did was I sold my AMSI as I was positive. I was green on AMSI.
Okay.
And I put it in WPay.
Okay.
So that's the Roundhill fund of funds, right?
Yeah.
So, I mean, if tech drops, WPay is going to drop as well. But at least it's not just one specific, stock. It's not one single stock. And I think, doesn't Roundhill use a strategy where they try to capture more upside?
They do. So they're doing list synthetic swaps. So what they do is, say, they're not a cover call strategy. I learned this from
That's right, they're a swap strategy.
Eugen Vasquez channel. He actually explains it relatively well. So what happens is they're doing predictions. So as soon as there's any momentum within the underlying holding, like there's some kind of like uphill momentum, then they are able to do puts. So the difference between what they called it at the original price and a difference in price, they sell a portion of it to get that distribution. So that's what happens. And you're able to, like, soon as basically you'll realize that because their predictions changes every week, depending on the underlying holding, then those distributions are also, basically it fluctuates a lot too. So you can have, let's just say, for example, the underlying holding of Palantir. If Palantir rockets up 1 week, then PLTW, which is the Roundhill weekly pay ETF that holds Palantir, then they are able to capture most of that upside momentum and sell that difference because it's magnified 120% and give you that, let's say, about 70 to 80% distribution, give or take. But
do you have any of the Roundhill?
No, it's I don't have any of the I don't have any, because if you play with these single stock holdings, you need to track the underlying holdings basically day to day, week to week, and you need to be aware of the underlying internal structures of the company. You need to be aware of any sort of global or tariff impacts on their company. And because the thing is, you have to realize that because Roundhill has that 120% magnified structure, it can go up and down more than the underlying stock. So technically speaking, if you want to sleep well, you probably don't want to play with any of these underlying holdings unless you're looking at it basically day to day, like you're tracking it day to day.
What about WPay?
I do have a
fund of funds.
I do have a little bit of WPay.
Okay.
But I'm kind of reevaluating the fact that when you have a basket, right, you have all of the underlying holdings, And so when you look at it right now, so I think WPay has about 10 positions, give or take. We have the Mag 7, so Tesla, Nvidia, Meta, Google,
Apple.
the seven,
Yep.
and then we also have Broadcom, we have Berkshire Hathaway, and then we have Strategy and Coinbase. Okay, so about 12 different holdings. So the vast majority of them are doing well for now in this bull market. Well, save for Strategy and Berkshire Hathaway and Amazon. They're not doing very well, so they're kind of dragging down the performance of WPay. So technically speaking, if you want to say because technically WPay is a basket of all of these holdings, but all of these holdings are still very concentrated in the NASDAQ. So you're not that diversified per se. Well, save for Berkshire Hathaway. But Berkshire Hathaway has not been doing very well in the last 6 months. So I only started a very small position in WPay and my RRSP because I wanted to look for a alternative to YieldMax, which I don't really like since about a couple months ago, YieldMax's performance has been kind of like subpar. So I'm kind of looking for an alternative. So maybe WPay could be that alternative, but I guess I've only had WPay for about 3 months or so, and it's doing okay. Like their NAV has been relatively stable for now because it's kind of like because I think they're doing an equal weighted allocation and equal weighted division between the 12 different holdings. So it's pretty much balanced out, give or take for now. So we'll see how that goes. But then it's really hard to say what could happen during a correction and whether their price could basically rebound afterwards. So it's just really hard to say. It really depends on Roundhill's inherent strategy. I don't know. Do you guys have any thoughts on that? Shawn, do you hold any?
I don't hold any of the weekly pairs. I just started getting into like bi-monthly pairs. Like I just opened up a position in Biggie. Is really
very nice.
Yeah, that's sort of my first one. I'm up to 10 shares of it now. That's going to be the one I'm actually, when payouts happen later this week or next week, that's what I'm actually going to start bulking up on. I'd really want to build that position. I really like it. Who would getting paid by twice a month is fantastic. And when you do the math, you can sort of build up what you're doing quicker, right? You get more monthly distributions, get them quicker, and build faster.
Fair enough.
Yeah, that's pretty much it for me.
And what about Paul? What do you think? What is your opinion on WPay?
On WPay?
Yeah.
I like it. What I like is that there's just so many ETFs nowadays. It's so hard to keep track of them and try to pick and choose which one's hot and which one's not. And, like look at Misty from YieldMax. For so long, it was amazing. And now all of a sudden it's $10 a share. You know what I mean? So I'd rather just take the fund of funds and not have to worry about it.
That's true. That's fair.
I'm using it in my daily Snowball portfolio.
Very nice.
Yeah.
So are you getting paid? Do you have ETFs that pays you every week, every day of the week at this point?
I do. I have blocks on Monday. I have MSTW on Tuesday.
Okay.
And then WPay. And now Thursday you get what? Alti, YieldMax, YMAG.
Right.
And I bought YBTC. Before those all switched to Thursday, I picked up YBTC. So now I got those 4 on Thursday. And then Friday, you get all the single stock from YieldMax, plus QDTE. I have RDTE. I have QQQY and WDTE. So I get a lot on Friday. Thursday and Friday, I get quite a bit.
Oh my God.
I'm trying to get 1,000. Between all of those, Monday to Friday, I'm trying to get 1,000 a week. That's my goal.
Okay.
Yeah.
Okay.
He's accumulating money for the weekend.
That's it, right?
Yeah, that's my weekend money. Don't tell the wife.
That's fair. And then how do you basically, I guess this is an important question. Do you reinvest everything like the next day, or do you pretty much accumulate everything in a week and decide on the next week when the market opens to decide what you want to reallocate in? Because I'm assuming like otherwise it's way too much, right? You're going to be trading every day.
I did put together a schedule. Like, for example, on Monday, you have to buy WPay to get paid on Wednesday. On Tuesday, you have to buy, I think it's YBTC to get paid on Thursday. So there's like every day of the week, you have to buy one of them.
Okay.
But then, of course, for Thursday, Friday, I have so much money coming in on those 2 particular days.
Right.
I save a lot of that money. And then I look for other opportunities, like maybe I want to load up on blocks this week because it's cheaper, so I'll buy more blocks or, yeah. So I am buying every day, though. I do, because of that daily snowball portfolio system, I guess it is, right? I do buy every day, and I have specific ones I have to buy every day.
Let me guess who influenced you that. Was it Andy PI?
Of course. Yeah, Andy.
Dude,
I kept reading his posts, and I'm like reading the post, and he's like, I've been doing this for 3 months and now I'm making $5,000 a month. And I'm like, what? How is this possible? You know what I mean? I'm not sure exactly what he started with, but I think he did sell some other positions to kind of like
probably, yeah,
beef up that, right? But still, like, I don't know, it seemed like it was growing fast and working well for him. So I'm like, I'm going to give it a shot. Plus, it's a case study you can do, we can do on the channel as well, like to keep track of it, right? So, it's something to have for content. So
there it is. Everything now that you guys are official, like I guess everybody is now in that YouTube creator mindset. You need to not only do it for yourself, that's beneficial. You need to know how to monetize it and create engagement, right? Because you need to create that other sort of income space.
I was even thinking today, because I know a lot of people really like XEQT, and then I heard about FEQT, and I really like the idea of it. So I was going to talk to Shawn about like maybe he should buy XEQT like $500 worth, and I could buy FEQT. We could add maybe $100 a month and see which one outperforms.
I love that idea, Paul. That's a great idea.
Yeah.
Assuming, because I'm very bullish on on the idea of Bitcoin.
Sure.
Who is it in my generation, right? Because technically it's a new era of digital currency. I would say I would be leaning towards FEQT. Clearly, because it has that 3% allocation in Bitcoin that you're buying pretty much consistently, whether it's on an upwards trend or during a crypto winter. So,
but I think they also manage FEQT differently. The way that they pick the positions, I think there's something about it that they manage it differently. I mean, if we're going to do it and we'll do some videos on it, I
think so too.
We'll have to find out for sure exactly, but
yeah. Because XEQT is very passive, so they tracked all the indices and so they have the TSX60, so they track that index in Canada. They have the VTI, so the total U.S. market index for the U.S. portion. So they don't have any concentrated picks in just the S&P 500 and the Nasdaq. They actually own the entire U.S. market, which I don't know if that's a good thing or not, because if you're looking at the entire U.S. market, there's so many micro companies, and
they own all of them.
I think they own a little bit of everything because they're tracking your entire U.S. index, so they're not.
It's almost like
enough.
You don't know what to pick, so just pick everything.
Exactly, and so I guess it's a good sense that it's more safe if you're more risk adverse. But you could also be too diversified in the sense that you're not capturing enough upside.
Right.
When positions are doing well, you don't have enough exposure to those positions. So you're pretty much taking the average when things are doing well and when things are doing not as well. So you guys have that balance. And then they have the from what I checked last time, they have the emerging markets index, and then they also have
something global.
Exactly. So they have the developed market index as well. So everything is basically on an index. Whereas definitely Fidelity they're doing something else. They're a bit more active, which for better or for worse, you can also clearly see that it's not just the crypto part. Their management fee is, I think, 85 basis points.
Okay.
In overall. Whereas the ones from iShares, the one from Vanguard and Horizons, well, sorry, not Horizons, it's Global X now. So Global X and BMO, they are all sitting around that 20 to 22 basis points, which since it's a very passive strategy that doesn't require much rebalancing, everything is tracking the index, it wouldn't make sense to charge a very high management fee because everything is pretty much set and forget it. Whereas definitely with Fidelity, they're doing something different. So I guess that could be an interesting case study you want to look at.
Yeah. I always, when people talk to me that are around your age and they're asking me what they should buy because they see the monthly income I'm making, I always tell them, if I was you, I'd buy XEQT, maybe FEQT or VFV, something like that. Like you don't need to necessarily start buying covered calls at 20, 21, 22.
That's a fair assessment.
You can, but
I think it also depends on each person's own risk tolerance, because until you know their entire, I guess, financial picture and their long-term goals, you can't really provide any recommendations because it might not fit well in their overall tolerance. Let's say, for example, some people are more risk adverse, some people are more pro risk, so they can tolerate risk more. So I guess to play it safe, you can just say any of the EQT portfolios. You can even go just with a regular S&P 500, which technically speaking is already globally diversified enough, because those top 500 companies already have, let's say, about 50% of their market shares already around the world. They're dominating technically the global markets. So, but then let's just say you are technically looking at anywhere between 5,000 to 10,000 stocks in any of the EQT portfolios versus just 500. So do you want to go more diversified, or do you want to go a bit more concentrated but still diversified enough to start with? So it's really hard to say, and then they really just have to do their own due diligence, clearly, because none of this is recommendations. People have to realize that on
we're
YouTube,
not financial advisors.
Exactly. So none of this is recommendations per se. Yeah. Sorry, Shawn, what were you going to say? Yeah.
People need to realize that maybe Paul and yourself, JJ, you've been doing it a little longer than I have, but you learn through
along the way
some trial and error what you like to invest in, what you don't like to invest in, what's worked for you, what hasn't worked for you. And you change up your strategy, right? And you get streamlined into what your strategy becomes and what you like and you believe in. You have to believe in it. And that's what you go forward with. Like some of the guys at my work, they're much younger than I am. I'm 53, and they're in their
good for 53.
20s. Yeah, late 20s, early 30s, and they're asking me, because they've seen the videos and they know what I get a month in distributions, and I'm like, this isn't for you. You're 29, you're 30.
Exactly. Yeah.
Yeah, you need to explore a little bit. Maybe Paul and I talk about it quite often too, even when we're driving around, and even when we were on vacation, we talked about it. I personally, if I was to start again in my 30s, I would probably have some type of hybrid account. Something that was maybe be like a 70-30, 70% growth, 30%, income every month.
For sure.
That way it's sort of feeding itself every month with income, and I can purchase more.
There you go.
But that's something I would do if I could go back 30 years, but I can't. And this is what I do now, but I love what I'm doing now. I really enjoy it.
Well, you have to also realize that a lot of the stuff that we have today was not available 20 years ago, right? You couldn't buy HHIS 20 years ago. You know what I mean? Most of the stuff you couldn't buy 20 years ago.
ETFs didn't exist 20 years ago, or
right?
Something like that.
Yeah. So, when we were younger, it was, I guess, you either buy stocks. And I bought a stock once when I was, I think, in college. It was like a $40 fee.
That's crazy nowadays.
You think it's expensive now? Like, the bank charges $9.99? No, it was like $39.99. That's why everybody was in mutual funds, right? That's how they got you. You know what I mean?
I mean, I would say like 30 years ago, mutual funds was the best innovation. Back then, because
unless you had enough money to buy stock, right? If you could have invested back then into bank stocks or Amazon or whatever was available, you'd make a killing. But
100%.
Most people couldn't afford it, right? All you needed was $500 to start a position in a mutual fund, and then you could do whatever, $50 a month, $75 a month, just contribute to it.
No, 100%.
That was easy.
Sure.
All right, Shawn, should we hit him up with the margin talk?
All right, big boy talk time, huh? All right, let's do it.
I have a couple questions about movies.
We want to grow our portfolios. We want to double our portfolios. So
I mean, Paul, technically, aren't you satisfied enough with the amount of income you're making? Aren't you making like what, $12,000 a month now? It's something like that, right?
So in October, I made 12. That was the first time. Thank you. Yeah, it was a great month. In September, I was just over 10. And I think November will probably be maybe just over 11 because of there's not 5 weeks in November. But you know what, JJ? I have 2 kids, right? I have 2 stepsons. I'd love to be able to help them more.
Yeah, for sure.
I'd love to be able to pay for their weddings. I'd love to be able to give them money for a down payment on a home. You know what I mean? I'd love to buy me a Corvette, right?
Oh, expensive taste. There you go.
Not a new one, just a used one. I'm fine with that. But yeah, I mean, it seems like it's a lot of money, but nowadays it's really not.
It's really not, if you think about it.
It's pretty sad when you think about it, but it's really not. So
yeah,
especially if I start pulling money out of my RRSP, I'm going to get taxed on it, right? So yeah. And you never know.
Remind me, is everything basically tied in your RRSP and TFSAs? Do you have anything in your non-registered accounts, or for the both of you?
6,000 in my non-registered account. Everything else is in my TFSA and my RRSP.
How is that allocation approximately between the RRSP and TFSA, give or take?
It's about 50% TFSA.
Okay.
Like 45% RRSP, and like maybe 5% in my non-registered.
Wow.
Yeah.
Okay.
And myself, I'm 70% TFSA and 30% RRSP.
Okay.
Yeah.
Are both of your TFSAs maxed out?
Mine is.
All right, Shawn, you got to get working on that.
Yeah.
I do. I'm a late bloomer, man. I lived large in a previous life. Lots of vacations, fancy cars. Now I have nothing.
Well, you have something. You got stories to tell, right?
I do have lots of stories, but yeah, I think right now my portfolio is at about $53,000. So I'm growing it, and I'm gonna grow it quick. By the end of next year, I want to be at 80. So I'm trying to, between distributions and banking money every month, I'm trying to put in between 25 and 30,000 a year right now.
That's it. That's a huge goal for sure.
Or I'll have to live off my wife's pension.
Oh yeah, because you don't have one, right? That's very unfortunate.
No, me neither. I don't have a pension either. That's the thing, right? There's nothing really to fall back on.
This is everything. So you really got to be prepared for it.
It really is everything. And I mean, in Canada, we do have your Canada pension plan, but I can't even,
much, right?
It's not much. And I can't even start drawing. The earliest would be at 60. So I still got 8 years before I can even touch it. So
what's your plan for the next 8 years?
We're both with Wealthsimple. So we're thinking about trying margin and,
okay.
But honestly, I hear about this margin maintenance, and I hear about, getting margin called, and I don't really understand any of it. So we were hoping you could explain, the basics and how we would start. Like, well, tomorrow, what would I do if I wanted to put 10,000 in my margin account and start buying?
Well, opening a margin account. So let's just start with what margin is. From a very beginner-friendly definition, margin or leveraging is literally using someone else's money. That could be a typical bank lender or with your broker, or it could be, this is clearly not recommended, but you can also get it from a loan shark. That's still technically lending, right? But at insane interest rates. So I don't know if you've ever heard of any horror stories, but people who live like paycheck to paycheck, but then stuck with bills that they can't pay, then they take some kind of like insta loan with any of those like very high interest lenders, but then give you access to cash immediately. But then they're hit with like, you can think of up to like maybe 70% interest rates, which is crazy. You don't want to do any of that. So we're not talking about any of that. But then, so basically margin, you can kind of think of it as borrowing money from the bank to buy a real estate property, say for example. So you have access to, because typically when you buy real estate, you never put, well, unless you're like a millionaire and you put 100% down, like 100% cash down on a property, which means that you're effectively using your own money to buy everything. But then otherwise speaking, you will be borrowing a portion of that down payment from a lender. So in this case, when it comes to margin, you will be borrowing money from the broker itself. So that's pretty straightforward and clear. And so what happens? So we're specifically talking about Wealthsimple's margin account. They're actually very easy to work with in the sense that you kind of treating it as like, if you remember when you open just like a non-registered account, just any taxable non-registered account with Wealthsimple, all you have to do is you just click on open a new account within the Wealthsimple, either the mobile application or the web platform. You scroll down, you go through the terms and conditions. Nobody ever reads that. You just scroll right down, click on you continue and accept, and that's it. You just start adding money to it. So realistically, adding a margin account is adding any other non-registered account, it's the same manner. You just open a new account type under the non-registered account. So now when there's the margin feature available, you would have two different account types in that subdivision of the non-registered group. So you have the regular non-registered account to open, and then you have the margin account to open. So click on that margin account, and then there's a disclaimer. I think they have that disclaimer where it's like you realize that you would be borrowing money from the broker to buy whatever you want to buy. So you click on that disclaimer, and then you're good to go. It literally takes about 5 minutes to open, maybe even less. And then you just would have to add money to that account, either from another account already with Wealthsimple, which would be the fastest, technically per se, or you would add money from your linked bank account. You would have access to that instant deposit feature, which means that money would basically appear immediately in your margin account, even before everything has been settled. So you would access to that, and then you can just start buying. So it's a pretty straightforward, really. It's not that difficult. Yeah. So that's the beginner basics.
And you can use that margin account within your TFSA, or is it like a personal account, non-registered account?
It's a non-registered account.
Non-registered, okay.
Yeah.
You can have multiple non-registered accounts with Wealthsimple?
Yeah. There's no limits. Yeah. Because everything is reported to CRA, and there's no contribution room. So theoretically speaking, you can open as many accounts as you want.
Yeah.
I don't know why you would ever want to do that, but
yeah. So do you have one non-registered account and one non-registered account that you use for margin?
Yeah, exactly.
Yeah. Okay.
So I have my other, like, technically speaking, if I was not doing this for YouTube and Blossom, I would just have that one margin account, because everything technically is classified as non-registered. But because I have that separate account that I'm trying to do a case study for, which I'm supposed to start, everything technically already set up in that account. Because I started it about a month ago, whereas I did a poll on Blossom. It's to really build a case study position that was actually taken from your inspiration, by the way, Paul, where I have a $35,000 position that I'm trying to build and have YouTube viewers and Blossom users to really take what they need to be inspired and clearly do their own research and not copy what I'm doing with this case study, because I'm not technically living off of this money. It's literally just to build a case study position that anybody else could use for their own purposes.
Using margin or no margin?
No margin for that account.
Okay, just $35,000.
$35,000 account using, I have that divided in 5 positions. So 4 positions equal weight between HHIS. We have C-Day, we have S-Day, and we have UTS. So the utilities cover call from bank.
How much is it making every month?
That's a good question. I didn't check. Let me double check. I think.
So you haven't figured out yet how much you're going to be pulling out of it?
Yeah. So I would say it's on average, it's about, I also have a very small yield booster in MST. So we have the harvest enhanced strategy position. So on average, you're sitting around a 20 to 22% yield distribution, give or take. I have to still figure out the specifics of how much I want to pull from that. But I had done this poll, whereas the most voted would be taken on. So you kind of pretty much take on the persona of someone either in their 20s, 30s, 50s, or 60s to realistically have like expenses that they want to pay for averaged out in that 8-month period and see how sustainable that pullout would be. And then after that 8-month period, see whether or not that NAV at that $35,000 is actually growing, decreasing, or pretty much staying flat, and do any sort of readjustments if needed, and then restart that case study at a different age with different expenses. So
okay, are you going to start that soon?
Yeah, pretty much. I literally just have to film it because everything's already done and set up in that account. And so to basically simulate those withdrawals, that's why I have that separate account. So those withdrawals in quotation marks are not technically withdrawals, because at every other account, my RRSP, my FHSA, the first home savings account, and the TFSA, they're all maxed out. So I can't technically withdraw to those accounts. So that's why I built this separate account that I can move to my margin account to simulate a withdrawal per se.
Okay.
Yeah.
Okay, so once we open the margin account, which sounds like pretty simple to do.
Yeah. It's
let's
very
say,
straightforward.
Let's say, just to keep it simple, we do $10,000 worth of margin. Do you have to pay interest on a monthly basis?
If you're when you're adding that $10,000, or have you already started buying stuff?
Let's say I use $10,000 of Wealthsimple's money, right?
Yeah.
I buy $10,000 worth of HYLD. So I borrowed $10,000 from them at whatever the rate is, 4.5% or something.
Mm-hmm.
So they charge you interest every month?
Exactly. So you actually, unless you've linked your TFSA as collateral to your now open margin account. Well, first of all, you actually have to add money to that margin account, and Wealthsimple will basically match that amount that you add into the account. So you effectively have double the amount of money that you have in that account. So let's say for example, you added $5,000 to that margin account, then the broker supplies an additional $5,000.
Right.
So total, you have effective buying power, which is the maximum you can buy, is about $10,000. So now you have access to that entire $10,000 position. But if you don't buy anything, well, if it's just sitting as cash, then there's no interest that you're charging on it because it's just sitting there. Right. So that's pretty much instant. So with the good and bad things about margin is that with a margin account, it's not treated like a line of credit, whereas you're borrowing money from the broker if you're not doing anything with it. So let's just say, for example, let's say you have access. So with margin and a line of credit, if you have a set maximum that you can take, then you can pull from that line of credit. So that's usually set by the broker. So let's just say, for example, you open a line of credit with a bank and you have access to $20,000 at the specific margin at that specific interest rate that is decided by the lender plus whatever prime rate that they charge. And so you have that access. So with margin, it's a bit different in the sense that it's not set in stone, in the case that when you have more money, it's basically tackling on to whatever you already have in that account. So it's not set at only like $10,000, $20,000, like a limit. You don't have that limit per se. So the more money you add into that account, the more buying power and margin you would have access to your margin account. And the difference between a margin account and a line of credit, the other difference is that with a line of credit, you need to go through a credit check, a hard credit check with all your lenders. And it takes usually a week or so, something in around that range, so like maybe anywhere between 3 to 7 business days, that the lender who's providing you that line of credit needs to go through a hard credit check to make sure that you don't have any sort of delinquencies on your credit report that they may red flag. Because if that happens, they could either reject your line of credit application or charge you a higher interest rate to guarantee that the whatever amount that you're borrowing, they can get that money back. So that's why you have different floating interest rates when it comes to a line of credit. Whereas with a margin account, that's usually preset by the broker at a specific margin rate, at a specific interest rate. That's, let's just say, for example, with Wealthsimple, it's about 3 to 4 basis points lower than what the big banks charge. So they actually charge a very nice interest rate overall. It's not the lowest I've seen in Canada, but it's definitely one of the easiest to have access to. And it is one of the lowest that I've seen besides international broker. That is usually pretty much the lowest. But when the difference between international broker and Wealthsimple is that international broker has different margin, it has different interest rates at different $100,000 tiers. So every time you have $100,000 more, they drop your interest rate by 25 or 50 basis points. So, but the difference with international broker is that anytime there's any sort of minor market correction or huge market drop, they can raise and drop the margin requirement, which is the amount of money you need to maintain in a position, say, to avoid any sort of margin call, which is when, if your position drops lower than this threshold, then the broker has basically has high priority to liquidate that position and guarantee that they get their portion that they put into that original account, and you lose basically the difference.
Oh boy.
So that's the thing you have to realize with any broker. Any broker that supplies you with additional money, they will always get that money first, which is the case of any lender, right? So anytime with kind of business, all the lenders get the proceeds or the losses first before it goes to any of the owners. So in this case, with this margin account, in a position that's losing and the broker is forced to sell that position, they get the proceeds first. Their guarantee is guaranteed, whereas you're left with, I guess, a loss in this example per se. Yeah.
Okay, I have a question.
Hopefully that wasn't too technical. Hopefully, Shawn,
No.
You understood all of that.
Way over our heads.
I got most of it.
Yeah.
How much of your available margin do you typically use? 50%, 80%?
I would say if you're using anywhere close to 80% of your margin allocation, you are very close to susceptible to any sort of margin call if there was any sort of minor market correction, right? Because you're sitting very close to that threshold. So when it comes to Wealthsimple per se, they usually have 3 different levels of margin requirements. The lowest is 30%. So you effectively, in any position, you are required to maintain a 30% position, 30% in an entire position. Let's just say a position is worth $10,000. You need to supply at least $3,000 of that position, whereas the broker provides $7,000, so 70%. So that is the minimum usually. But then there's also 50% margin requirement, which is typical of new releases on Wealthsimple, such as Biggie. Let's just take Biggie as an example. Right now in Wealthsimple, they need to maintain that 50% margin requirement, which is you're effectively borrowing a 1-to-1 position. So you're supplying $5,000 of a $10,000 position, and the broker provides an equal amount of $5,000 in that position. So there's that. And then I haven't seen this, but you can also have 75%, whereas you supply. So it's flipped. You supply most of that money and the broker gives you a minimum amount. And then there's also 100%. 100% basically means that there is no margin. You're not borrowing any money. You're supplying 100% of that value. And you can kind of see of it as if you're buying anything at that 100% requirement, you can kind of think of it as gambling on meme stocks, penny stocks, on something that's basically not very safe, or either is just released that just became public, or has super high volatility that the broker is basically, they're not taking that chance basically, or gambling. Kind of think of it as that. Yeah. So that those are the differences.
Okay.
JJ, I got a question for you.
Yeah.
Go ahead, Paul.
Let's go.
So let's say Shawn and I decide to do this.
Mm-hmm.
We open our margin account, we get some funds in there. We buy some positions. December rolls along, and we get $1,000 in distributions.
Right. Yeah.
What do you do with that $1,000? Do you pay down your margin? And if so, how do you even pay down your margin? Is it like making a bill payment or?
No. So when it comes to Wealthsimple specifically, it goes, so every time your distributions come in, first of all, it automatically goes towards your capital borrowing balance. Any distributions you collect, either semi-monthly, it's not bi-weekly, semi-monthly. There's a difference, actually. Yep. I don't know if you saw this, that when Gary did that whole interview with Raj, the Evolve CEO, the Raj clarified the difference, whereas that when you have bi-weekly, you're getting payments, you're getting 26 payments.
26, yeah.
26 payments in a year.
Bi-monthly is 24.
Bi-monthly is 2 less. Yeah, so 24.
Yeah.
So that's that difference. So every time you have a distribution that comes in, instead of you having that as cash, Wealthsimple automatically pays down that borrowing balance. So it's automatic. Okay. Yeah. And so if you want to rebuy any more positions, then you're basically taking out another loan. So it adds on. So you're basically adding on to that margin balance. So every time distributions come,
get you to keep using more of their money.
Exactly.
Okay.
Exactly. So,
So
every time
after a while, eventually the margin will be paid off and everything in that account will be yours.
Exactly. That's the point, right? And technically, when it comes to margin calls, it's not as scary as people realize, because you have to realize that what are the different ways that a 0% commission broker can make money. Number one is on other financial products, which not all brokers have. Number two is the difference in commission fees, exchange fees. Sorry, when it comes to commission-free broker, you have the difference in exchange fees that they can charge when you're changing in currency. So Wealthsimple charges a 1.5% exchange rate when you're exchanging from US dollars to Canadian dollars and back and forth. So they always charge that 1.5% exchange rate, which is actually going to change in January. They're actually bringing Norbert's Gambit. So they have that. Yeah. So they're bringing Norbert's Gambit in January. So, and the other way is through interest, through borrowing. That is, probably the best way for a broker to make money, because they can charge a very hefty and very healthy interest rate. You as the borrower get to keep the rest of it, as long as you make smart decisions and don't over leverage yourself or take on risky positions that you're constantly swing trading and you're not doing it smartly. And so the broker really wants you to take as much margin as you can, because they're actually making more money when you're borrowing more. So technically, it's a win-win. It's a positive relationship between you and the broker when you make smart decisions, buying broad, buying safe, buying index in either index positions or index-like positions, anything that's in a basket. You can kind of think of it as diversified, and they always they always get more interest every month. And so, even though, let's just say even during a market correction and you do over leverage yourself and you're technically in a margin call, as long as you are diversified, it can be that margin call, so that when you go below that 30% margin requirement for most of these positions, it can be a margin call of like $1 or $100 or $500. So not that much. And they actually give you a 3 to 5 business day period to add more money to that position. So they give you the choice between either adding money to that account to bring you back over that 30% margin requirement, or they also allow you the choice if you want to take on that basically capital loss and tax loss harvested somewhere else, that you're basically balancing out any capital gains that you also made in that fiscal period. So they give you that choice in that 3 to 5 business days to either add money to that account to exceed that margin call or sell that position yourself. So they give you a lot of fluctuation. They give you a lot of flexibility to basically avoid and solve that margin call yourself. So because when it comes to the lender, margin calls are actually not great for them either. They're not going to be making much money, because as soon as they close that margin call position, well, they lost all the interest that they could be making in the future. Because as soon as you close the position, well, technically speaking, there's no more interest they can make. So they actually lost a huge portion of whatever money they can be making. That's why they also give you that much flexibility. They will constantly email you. Actually, as soon as you hit a margin call, they will constantly email you to resolve that, because they want you to resolve it yourself. And so if you have any sort of technical issues, you can even call their customer service and set up a relationship. Whereas, let's say, for example, because if you're in a margin call and you don't have any free cash available in any of your other linked accounts, so this is one thing you have to realize when it comes to Wealthsimple specifically. If you're in a margin call position, instant deposits, so every time you add money from your linked bank account, so technically instant deposit feature is that you have immediate access to that money that Wealthsimple technically lends to you before they settle it with the bank account. That instant deposit feature is nil. So it's no longer functional for any of your accounts during that margin call. So if you are stuck in that position, that because it's kind of like these money transfers from your external bank account can take 3 to 4 business days. And so that margin call can also technically take 3 to 4 business days. So if you're stuck in that pinch, you can actually tell your margin. You can actually establish a good relationship with Wealthsimple, and actually they can extend it. So there's a lot of flexibility because it's not beneficial for them. It's not beneficial for you either. And as long as you're doing it smartly and you're maintaining, I would say, a good hefty margin position. So in my case, for example, because I have technically a higher risk tolerance, so I would probably sit around that 50 to 60% margin position. But my risk tolerance is very different to someone else who could be in their 40s, in their 50s, in their 60s, who have way more factors in their life that they cannot take as much risk. So they might want to play safer. Start with a 1% margin position. Go 5% if they can tolerate more risk, and then go even higher. But then when it comes to that, I would probably recommend not going over that 30% range, give or take. And I don't know if you saw when Jordan from Cover Call Investing, he made that whole playlist, that YouTube video, that 1 hour and something hour long YouTube video, where he went over all the specifics on margin and how he's using it for his experiment. He's basically taking around the 16 to 20% yield for his case, which makes a lot of sense because he has 4 kids now. So he has a lot of dependents. So he does not want to over leverage himself because he is the sole income producer in his family.
What did he buy with his margin? Do you remember?
He has 4 different positions, if I remember correctly. It's all Canadian listed and on Canadian holdings. So he has bank, Utes, ECHI, so ECHI, the 9 points, all in one. And then it's either CDAY or HHIC. It's one of those two. Everything is Canadian listed because his TFSA, his RRSP, his Basel RRSP, they're all focused on the US. They're all Canadian listed, but the underlyings are all US holdings. Whereas for his margin account, he wants to be safer, so he went Canadian, which you can kind of see is more defensive, which is perfectly fine for a margin account. Yeah. Hopefully that answers your question, Shawn.
Yeah, it does. Thank you. That'd be absolutely. Paul, do you have any more questions? I have another one.
Yeah, go for it.
Okay. When you're using your margin, how concentrated is it in one sector, or I assume you're not using it on one particular stock? Do you try to keep?
Not.
No. That's
all on Tesla.
Yeah.
All on Tesla, right? Yeah, that's it.
Do you tend to keep using margin just for one sector of purchases, or are you spreading it across different sectors?
I have it spread across different sectors and different risk tolerances. So in my case, because I am an investor that doesn't like to look. So I am not as active as Paul, clearly. So I only do trades maybe like once a week. So because I have a whole life, like my life is not spent in the stock market, it's not spent on Wealthsimple. I maybe log in like once a week, once every 2 weeks if I'm feeling lazy. So I have everything pretty much automated. So I don't want to be looking at it every day. And I don't want emails, basically, in case I get margin called even by like $1. I don't want to look at that because it's kind of like if you're comfortable looking at the markets every day, then I guess you'd be comfortable taking on more risky positions because you can take on strategic allocations that you know that could be better. But in my case, because I'm more passive at this current stage in my life, because I have different businesses, I have school, I have all of that focused. So my energy and concentration is focused elsewhere. So I need to be more risk adverse. That's not the right word. So less risk, more diversified, and lower yield. And so all of my picks in my margin account, definitely I treat it as like an alternative to real estate. So you need that monthly cash flow to pay down your borrowing cost. And as soon as there are any good deals, then you can buy more and lower your cost base. So I treat it as all my positions need to pay at least monthly to simulate a cash flowing real estate sort of simulation. So I have that. And number 2 is I don't have more than 15% allocation in that margin account in any holding.
Okay.
And the vast majority, I would say at least 90%, is in a basket. So I need all-in-one ETF, an index like ETF, or a closed-end Class A split share fund that is diversified. So not more than 15%. That could change. That could be even lower if they are concentrated in one sector per se. Yeah, but I also have like 5% give or take, 5 to 8% give or take in single stocks if I feel thrifty. Yeah.
Have you noticed, can the brokerage, or Wealthsimple in this case, can they change its house margin requirements at any time, or do they give you notification?
International broker does this during any market correction. Whereas with Wealthsimple, they could change it. They will change it most likely. And I've seen this during the whole April Liberation Day, when that whole massive drop, a massive up spike went. So during that massive drop period, broader index-like funds, both in the US and the Canadian market. So you have the typical, USCL, QQCL, HDIV, HYield, you have QDTE, RDTE, QQY from Defiance, all of those more broad exposures, they kept it at that 30% margin requirement. But then when it comes to more riskier positions, then that are specifically focused on, single stocks or single sectors, then they will up that margin requirement to at least 50%. I haven't seen them up it even further past that 50%. That's not to say it could never happen. So just be wary of having too much exposure to single sectors or single stocks. So that's just something you have to keep in mind when it comes to any sort of market correction moving forward. But you are pretty safe if you focus at least the majority of that margin account in broader exposures.
It almost answers the question I was just going to ask you, because right now everybody's talking about, there's a crash coming, the market's too hot. Do you
believe that?
You know what? I'll be honest with you, JJ. Since I took over my investing, right? So pre-2020, I was just, I'd sit down with my advisor once a year, take a look at insurance and budgets and other things, right? And then you just decide, okay, I'm going to send you $500 a month, invest it, right?
Yeah.
So after that, right, and I started investing on my own. So obviously there was the crash in 2020, but that recovered quick, right? That recovered pretty quickly. But then I feel like from 2021 on, it's always the conversation. It's always the conversation. Oh, the market's doing too well. It's going to crash.
Although 2022 was pretty bad.
2022 was a bad year.
Yeah.
But was it a bad year that you couldn't recover from? Not really. Not me, anyways, personally.
Unless you gambled on any single position, then you actually realized that loss. Well, yeah, technically, but
you know what? I had some REITs like Innovalis got destroyed, right? So that's why I don't really touch REITs anymore. I know there are some
very well.
I know there are some good ones, but I'm not even touching REITs anymore. So I mean, okay, a few positions of mine did get destroyed, but my portfolio as a whole has not. Right? I mean, if you look at my monthly income from 2021 to 2023 and so on, it's just gone up and up and up and up. But anyways, just to answer your question, it seems like for the last 4 years, people have been talking about a big market crash. You know what I mean? And we seem to get little ones here and there, but
because it drives that volatility, right?
But it seems
drives
like it's a lot more market manipulation, right?
That's another conversation, but I would say I would agree with that.
How do you feel, JJ? Do you think there's a crash coming?
I would say regardless, yes or no, just keep buying. As long as you have strong conviction in your holdings, because you have to think long term. Unless you're a swing trader and you want to capitalize on those positions, let's say for example that you have strong conviction in a stock, and you could say and you can predict that a market crash could be coming, you could then keep a large portion sitting in like a treasury fund or like a money market fund that's earning at least some kind of interest. And then if that does happen, then you capitalize on those holdings that you have strong conviction in. I believe Gary does this with his value picks. Because I don't know, Paul, if you remember, but then when you and Gary had that whole episode and you guys were discussing, when he was discussing his strategy, he has essentially 3 different buckets of strategies. So he has his typical growth portfolio within the, the typical VFV, VOO, QQQ, VCN. So actually, no, I think his growth portfolio is in just the US sectors.
It's mostly VFE, right?
Yeah, exactly. Mostly VFE. But then the majority of where he's basically making his money is in undervalued value stocks, value picks that he has strong conviction in, that he buys a huge chunk on his way down, and then maybe he will hold it for like 5 to 10 years until it recovers, and then he can capitalize on that. But then that can only work that's a very high risk position, because technically, even if you're basing it on historical trends, which I think he is doing, at least with his United Health position, I don't know how much he has, but I'm pretty sure it's a good chunk that he has invested in it. Even though historical trends are important, that could always change moving forward. So I would say that's a pretty risky position. Yeah. I probably wouldn't do any of this, because you have to have a very strong stomach, because it can always go wrong. And because it's a single stock and it's not an ETF, even if let's say, for example, an ETF like goes bankrupt, like it gets delisted or something, you would still get the NAV price.
Right.
So you get some kind of payout. But if a stock gets delisted, you get nothing. You lose all your money.
So what I was going to say to you, JJ, was with you having margin and everybody talking about a crash, does that make you nervous that, your account, you could end up being margin called, or?
So be it.
Yeah. Okay. So you're not nervous about it?
No, not really. Because when it comes to my positions, like all of the vast majority, 90%, are in broad indices. So you have HYLD, you have USCL, you have QQCL, you have GDV, which is the Brompton Global Split Share Fund, which
Sounds
is
like a wind tunnel, eh? Can you hear that?
Yeah, it does. So it's a more defensive position, because they're all dividend grower companies around the world. So it's more defensive. And then I also have S Day in there. I have C Day in there. I have Bank in there. I have Utes in there. I have HDiv in there. So it's and I have a couple of single stocks that not doing as well. So I actually had a little bit in Coney and Missy still sitting there, but it's only at about a 1% that margin account. So my exposure and risk tolerance is pretty much balanced out 50-50, give or take, between more growth and less growth, so more defensive. So because even during a market correction, defensive positions will actually be positive NAV-wise, and during a strong bull run, those defensive positions could actually be at a lower price,
right? Because
they're not doing as well. So you can kind of think of it as you're basically capitalizing on these positions, regardless if it's a bull run or strong, or it's a flat run or a bear run. So there's always ways that you can keep buying more and then reorganize and recalibrate depending on how things go forward. So that's why I always like to have multiple different positions in my margin account specifically.
Yeah, no, I agree with you. I think that like when the crash comes, great, people are bailing out of when people are bailing out of technology, they're going to be throwing all their money into utilities, right? So then your Utes is going to skyrocket.
Yeah.
Now you can sell it at a gain and buy technology.
Exactly, because I think it's a good plan. Now, because during the past 3 days, there was a slight market correction. Utes and Bank both were positive by 5%. So I was like, okay. And then as soon as it rebounded technically today, Utes fell by 5%. Yep. So you can kind of think of it as, okay, even with these kind of small micro movements, you can already kind of predict what could happen. So that's why during these days, I would buy and sell Utes. So Utes is kind of my Utes and Utes and S Day are pretty much my defensive positions throughout my entire picks. So you can really reallocate.
Anything like ENCL, any oil as a defensive? I do have oil,
yeah.
Yeah, me too.
Although, is oil really a defensive position? Because it's very...
It's cyclical, right?
It is cyclical, but
And I
it's
think
not
when people
behaving as well. Yeah.
bail out of tech stock, they're going to have to put the money somewhere, right?
True.
So they'll probably put it in finances, utilities, and oil.
That's true. Yeah.
I could be wrong. I'm just guessing.
I think I would
guessing.
say so, because when it comes to the Canadian market specifically, financials, oil, and well, basically in Canada, it's pretty much defensive. The
That's
vast
right.
majority of the top 60 companies are all defensive picks.
Yeah.
So you can really pick an all-in-one basket like C-Day, which has the vast majority of those companies already. That's pretty much spread out. Or you can pick and choose like financial. So you have bank, and then you have the utilities, Utes, and then you have oil. You can either pick between Oily, OILY from Evolve, or you have ENCL, or the non-leveraged ENCC positions. So you have different picks that you can choose. If you want to just go with one position, you can just go with C-Day. Or even if you want to be even more risk adverse, you can even go like just the regular dividend growth ETFs. So you have the one from VDY, from Vanguard, and XCI or XDIV from iShares. So there's a lot of different choices you can pick and choose. And that's also a good thing, to have different positions that you can strategically rebalance and reallocate. So you can really play with that. But then if you don't care, you can just set and forget it. So you can just keep buying regardless,
Yeah.
That's it. That's why every investor has a different tolerance, has a different mindset. And Gary did always brought up a really good point, is that it's very important to keep in mind that everybody has a different vision, has a different financial goal, has a different risk tolerance, has also a different risk preference. And so you can't copy blindly anybody's trades.
No.
You have to understand each person has a different portfolio, financial portfolio, and nobody is an exact copy of anybody. It's really to nitpick their thoughts, their convictions, and to realize any sort of those convictions can sit with you, but then a good portion also doesn't agree with you. So you need to always do your own due diligence. So yeah, there's that.
Yeah.
Absolutely.
Well, I don't know if you guys noticed, but we're getting close to an hour and a half.
That's very good.
Yes.
Yeah, it's very good. I'm wondering, Shawn, if we should go for wings tomorrow night. We can talk about opening our margin accounts.
I think it's a fantastic idea. We'll drop the wives off to go line dancing, and then we can meet up for wings.
Yeah. And maybe, JJ, maybe in a month or two from now, we could get back together again and go over what we've accomplished.
Sounds great. I think doing a monthly regrouping just to report on your progress could be very nice for a case study, for an ongoing case study.
I'm down for it, for sure.
Absolutely.
So let's before we end this podcast, let's basically go through your thoughts and convictions on how you want to get this margin account, both of you. How do you want to start, and what's your plan, per se, like moving forward?
What are you thinking, Shawn?
Yeah, just give the viewers a little bit of sprinkling here and there.
Well, between Paul and I'm usually the gambler.
Okay.
I'm the one that
go big or go home. Is that it?
Sometimes.
Okay.
Swing for the fences, eh?
That's it. Yeah.
Might as well. I think I'm gonna. Oh boy. Even since we had a little conversation about this before, I've been. It almost comes across my mind daily thinking about margin account.
Mm-hmm.
I'm not afraid to jump in both feet. Go to the deep end, go hard. I'm just worried about what my wife's gonna say.
Are you gonna tell her?
She won't know. She won't know unless you tell her.
Well, she always seems to find out.
Yeah, well, she's
She
probably going to watch
watches
this
these videos.
episode.
She's very active, huh?
His wife watches the videos. My wife doesn't. She just edits them.
Yeah.
Technically,
So
isn't she technically watching it while she's editing the video?
Yeah, she's got a way of doing it without actually watching the video.
Yeah, JJ.
Okay.
I watched her edit a video. She watches for Paul's mouth to open, and that's when she knows to cut the video. And then when it closes, she snips it there and deletes that little bit. So she has it down to a science.
Wow.
Like if I'm talking and then I share my screen,
mm-hmm.
right? So she knows where I'm sharing the screen when I stop talking.
Right.
Then she can cut that in between part. But anyways, that's a whole other conversation.
How about you, Paul? Are you gonna tiptoe in, or do you think you're gonna, sort of maybe go in the shallow end?
Well, no, I want to open up the margin account, and I think what you said was I could use my TFSA as collateral.
Yeah.
And then that way I'll get more margin, right? I'll get more access.
You would have access to more money, but then remind me, in your TFSA, is the vast majority in US high yielders or Canadian high yielders? Because that will be a difference.
It's mostly Canadian.
Mostly Canadian? Okay.
Yeah, mostly Canadian.
So
Yeah.
when you have a TFSA as collateral, there's going to be a difference in the amount of buying power you will add to your margin account, whether it's sitting as cash, because then you would get that. So if you're sitting as cash, then you have the maximum buying power. But then if it's already in positions, so it's not sitting in cash, then that can also differ in the amount of buying power you would have access to. So let's say, for example, if the vast majority of your TFSA is sitting in Canadian listed ETFs that are, let's say, vast majority at 30%, then you would have a higher amount of buying power when you add it to your margin account versus having the vast majority of your TFSA in single stocks, which could be at 100% margin requirement, or cover call ETFs on single stocks or on US listed funds at 50%. So that can always change the amount of buying power you would have access to.
Like the funds that I already have in my TFSA, I own those, right? So there's no margin requirement for those, is there? Because they're in my TFSA.
They are in your TFSA, but when you add as collateral, then that changes the amount you can borrow.
Okay. What I'm trying to avoid
if you're playing more risky, because that amount you can borrow that adds onto your margin account, that will change based on the value of your TFSA.
Right.
That too. So if you have very risky and volatile position in your TFSA, then that can change day to day more often.
Yeah.
Whereas if you're playing more safe, then you can kind of predict a guarantee of how much, give or take, you would have on a given day, on a given week.
Maybe you could tell me the best way to do it. In my mind, what I'm trying to do is get, say, $10,000 of margin without having to put $5,000 of my own cash and then getting $5,000 from Wealthsimple. I want to access $10,000. So open up a non-registered account, maybe deposit $100, but then use my TFSA as collateral so that I can get that $10,000. Will that work? Or
that would work. Yeah. That's
okay.
just perfectly fine.
Yeah. And then what I'm thinking about doing is just pick 5 ETFs that are, like you said, maybe between the 10 and 15 yield or, percent yield, and put $2,000 in each.
That works.
Yeah. And then it's just start from there and see how it goes, and
I would say
learn
the biggest,
as I go.
Yeah, exactly. So when it comes to any sort of big decision, it's always the beginning. Whereas you have concerns, it's always the unknown, that you're basically, you could be your biggest enemy in making any decision. And so it's always to realize that taking that first step and optimizing along the way is way better than trying to finesse it at the very beginning of a plan and not taking any action at all.
Yeah. See, for me, JJ, like, I don't mind buying something like Alti with some of my distributions. And if I lose 100% of it, I'm okay with that. But I don't want to buy Alti in my margin account, borrowing the money from Wealthsimple and lose 100% of it and then owe them money. That I don't want to do.
That's not a good idea for sure.
Yeah. So I would rather any stock I'm going to buy that's a high yielder or that's risky, I want to do it with my own money. And then in the margin account, just buy ETFs that will pay the margin down, and make me money over time.
Yep, that works. And then if you have conviction in a single holding, then you can even swing trade it if you want.
Yeah. Well, we'll have to talk about that.
That works. I'm not swing trading anything right now, but I can advise you on what you think have strong convictions in.
I usually do that with ENCL. I talk about that on Blossom every so many months because I kind of know the price box, right?
Yeah.
So when it gets to a certain point, I sell shares and then I wait at least 30 days. And when it drops down, I buy them back again.
Yeah.
And people ask me, like,
solid.
Isn't the CRA going to get you in trouble? But I'm not doing it on a daily basis, right?
Are you doing that in your TFSA?
I am. But let's say, for example, I sell 100 shares of ENCL, right? I don't buy them back tomorrow. It's not like I sold them today for $20, tomorrow it went to 19 and I buy them back again. Because if you start doing that, you're going to get in trouble.
You will, yeah.
But I think you can sell a position and a month or 2 months later buy it back again. It's not like you can never buy it again.
Yeah, exactly. As long as there's at least a 30-day period where you're buying and trading the same stock, then you should be fine. Yeah. Because it's not day trading, then you are completely fine.
It seems as if I'm very active, but I'm usually just buying, right? Like I have HHIS and I'm buying another 10 shares. I'm buying another 20 shares. I'm buying another 30 shares. But I don't think you can get in trouble for adding to a position. No. You're just buying more stocks, right? That's not against the rules. It's when you sell it and make a profit. Yeah. Right? And then
it's if you're buying and selling frequently within a 30-day period.
Yeah.
Well, we don't know exactly how frequent that threshold is, but I think a good safe metric is not buying, let's just say not selling a complete position. Like you sell all your position and then rebuying that back within 30 days.
That's right.
Then that's something you want to avoid. But if you're buying a little bit, buying a little bit, buying a little bit, selling a little bit, waiting a little bit, buying more, sell a bit more, wait again, you're fine. Then CRE doesn't care about you. You're not making that much money in the first place.
Exactly, right? For the few $100s that I make, right?
Exactly. So, it's only if you, let's say you make like hundreds of thousands of dollars. Okay, then.
Yeah. Well, didn't you hear about that guy who built his TFSA up to like $750,000 by day trading in his tax-free savings account?
Yeah. Well, if you're day trading, then
you have to pay tax.
Exactly, because you technically didn't earn that money yourself.
Yeah, you did, but it's a business.
Well, sorry, that's not what I meant, but yeah.
Yeah, it's technically like a business. Once you start,
you're treating it like a business, exactly. The government is always gonna. Yeah,
I think you can do it in your RRSP because
it's tax deferred. You haven't paid any taxes yet, so the government is like, okay, if you want to make so much money by day trading, give me that money when you withdraw, right?
When you pull it out, you're going to pay them, right? They're going to get their tax. So
they're getting paid.
Exactly, and I believe it's the same rules with the whole first home savings account because, like an RRSP, it's also tax deferred. You haven't paid any taxes on it.
Yeah.
So you can day trade as much as you want in that account, but then you technically, because if you don't do anything with that first home savings account, it gets transferred to an RRSP. So then technically at that point, you could be paying taxes, but then if you're using it all towards the first home, then you're completely fine. Well, the government is going to get their portion later on when you sell.
I mean, for me, I wouldn't recommend that for most people because most people will probably lose day trading.
Exactly.
And you don't want to do that with your first home savings account.
No.
It's pretty sacred. We don't get that many bonuses when it comes to this country. So
and it's hard to buy a house. Hard to buy a house nowadays.
Anywhere really, if you think about it.
Yeah. All right, guys. So
that's a topic for another day, for another conversation.
Sure. And we appreciate your time, JJ.
You guys too. You guys are great guests on my
thank you very much.
Slowly growing channel, very slowly, but hopefully everything goes well. Yeah.
You've educated us. We've learned. I think Paul and I have definitely learned something tonight.
That's great. Yeah. I think that's the first goal. I think the whole point of me basically transitioning over to Blossom is, well, Blossom, there is a good chunk of Blossom users that are on YouTube, but a lot of people who are using YouTube are not necessarily on Blossom. So that's kind of why that transition over to a new platform. And I'm probably also thinking about taking the clips that I generate from these longer form podcasts and send them over to TikTok, which would then reach another audience of a lower generation, get them financially aware of what is possible in their early 20s, even in their late teens, get started building that mindset and to grow your portfolio, grow your financial awareness long term. Because the one thing that is pretty much, I guess the one great thing is that education is very sacred. You can never take that away. So building that financial education earlier on is very beneficial long term. So I think that's a very solid advice for anybody out there.
Definitely. Yeah. And just recently on my videos, I started, and on Blossom, mentioning that, young people should start reading a bit as well. I mean, we all watch the YouTube videos. Some of us are on Blossom, but I started out with The Wealthy Barber, and honestly, it laid
It's
a
a
good
great book.
foundation. It's a great
for
book,
sure,
right?
yeah.
So I think what I say is just take out the mutual funds and put in ETFs or XEQT or substitute, something for the mutual funds. But otherwise, the book's
Something
fantastic.
updated.
Yeah.
Like
Isn't the author, I think he's coming out with a 2.0 version.
There is a second book already.
Yeah.
Yeah.
No,
there's a
like an
second book
updated
already.
version of the
Another
original Wealthy
one.
Perfect. I think he's
Okay.
updating it now for the 21st century. So
Yeah.
I think that's going to coming soon.
Yeah.
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 Yeah. And for anybody who doesn't know, get on Blossom. Well, we'll put links in the description below, and I always put a link in the comment. But for
Yeah,
people
I always
who are
have
not
it
on
in comments.
Blossom, yeah,
So on my end, if any viewer who's seeing it on my channel, I will have basically, Shawn, you should actually send me your Blossom portfolio because I only have the one from Paul. But I have basically everybody's channel linked, everybody's portfolio to Blossom also linked. So you guys will all have access to that as key resources to look at.
sounds good.
Sure.
I'll have to figure out how to put a link to your channel in our video as well.
Sounds good. Yeah, I'll send that
figure it
over.
out.
So yeah,
Yeah.
It's pretty
Just
easy.
send it to me. Sounds good.
All right,
guys.
everyone. So
Yeah.
this is a very casual, unscripted, actually. This is a very spontaneous conversation that hopefully everybody was able to take in relevant and useful information from this entire podcast and use it to build their own financial awareness and share it and for anybody that found this useful. So once again, this is Convos with JJ, your co-host, and then we have Paul and Shawn from their channel Better Call Paul. And so everybody, hope you guys all like this episode, and we'll see you in the next one. Bye for now.
Have a good night,
Bye
JJ.
for now.
Have a good night, Paul.